Iron condors versus calendars. The reason we're talking about this subject today is because we did in our VTS portfolio take a new trade within this iron condor strategy. So this is our 4 strategies that we have in our overall portfolio. They're all different. They function a little bit differently. This position here for the iron condors, this one sort of fills in a hole within the portfolio where, tactical rotation and trend following strategies, they do have a difficult time making money in difficult markets. Obviously, you do need a little bit of a trend. And so the iron condors being a more market neutral strategy, like I said, they fill in gaps in pretty much everybody's portfolio. I think that most people could benefit from some market neutral exposure. So the iron condor is basically shaped like this after you construct it. It's a 4-leg option, but don't worry if you're new to options. It's all done in a single transaction. Basically, it just gets built for you as an iron condor. So when you click on iron condor, it will build all 4 legs for you, and it will all look like this. But, it might look a little confusing in the beginning, but trust me, it's not. But essentially why we're doing this is because, if you think about what's happening in the market, let's take what we're going to be trading today, which is gold. Here's the price right now. And, obviously looking forward, we don't know where the price is going to be. Right? So this is expirations going out in time, those red hash lines. We don't know where it's going to be here. This is actually the cycle we're going to be trading. But what we do know is that we would probably expect that, as I always say, the best indication of what's going to happen tomorrow is what's going to happen today. You can always pretend that you're going to play the contrarian and you're going to catch that reversal exactly right. But typically markets reflect what they are currently doing. And that actually plays out further in time too. Most of the time, markets are just chopping around in a reasonable range. So what we're trying to do with this strategy is we're trying to basically just catch whatever's coming going forward, knowing that we can't really predict the direction. Maybe things get really good. Maybe everything in the gold market stabilizes. Maybe it doesn't and it crashes down. But we know that there's a pretty decent chance it's going to land somewhere in there. That's what we're trying to do. So if you flip this shape on its side, you can kind of get an idea for what we're doing. This is the iron condor. It throws out a really wide net and it catches most future prices. Now, obviously it can go higher or lower, but a pretty high percentage of the time we're going to catch that right. Now, the iron condor itself, you don't have to know these Greeks exactly. You just have to know them sort of conceptually speaking. I don't want to math it up here. It's very basic stuff. But the only Greeks that I really focus on are delta, theta, and vega. Now, this is important because this is the subject of today's live stream, why we are eventually going to introduce what's called the calendar option. It has to do with something within these Greeks. So the first one, delta. Delta just refers to the price direction in the market. So, specifically, delta shows how the options value changes given a $1 change in the underlying stock price. So basically, as the prices are moving around, up or down doesn't matter, but we do kind of want it to stay in this range. That's why whenever we're talking about iron condors, we call them neutral. We call them market neutral, delta neutral trades. Up or down is fine, just hopefully not very much. Theta is basically the sensitivity to time. Theta shows how an options value will change, all other things held constant, that's important, of the passage of one day. So this time, it shows that, over time, this iron condor will make a little bit of money each day. The longer the price stays in this middle range, you'll just pick up a little bit of premium every day. That's how theta works. And the last one, this is the important one today, vega. This is the volatility component. Vega shows how an options value will change given a 1% change in volatility. Now, iron condors are vega negative. This means they are essentially short volatility trades. They benefit as volatility declines. So if you open an iron condor, for example, in mid to high volatility, then there's a pretty good chance that it's going to have much wider wings. That's the first thing. And there's just a better opportunity for profit because volatility can either stay where it is or it can likely come down a little bit and you can make your profit. However, this is where it gets tricky because what if volatility is already low? From that point, it's actually hard to imagine that it's going to just continue getting lower and lower. So the iron condor kind of gets squeezed out and the margin of error actually shrinks a little bit. The wings get narrow and your trades are actually more susceptible to losses. So now, finally, the punchline, this is where the calendar option comes into play. These are very, very similar trades. They look different. This one looks like this one, shaped like that, but actually they're very similar. So the first thing, they are both delta neutral, right? Both of them will profit if the price stays in this sort of middle range, not moving too far up or down. Now, you do have 4 or 5% either way. It doesn't have to pin on that price, but they are both delta neutral. They're also both theta positive, which means, again, if the price hangs out in that middle range, you can just pick up a little bit of profit each day, and then, 20, 30 days down the road, maybe close the trade for your gain. The third one, though, the Vega component, you can see this one says positive and this one says negative. This is why within our Iron Condor strategy, we actually use both Iron Condors and calendars, depending on the volatility environment. Because if volatility is already low, then calendars will actually be a little bit better. So let's take a look at 2 trades here. The first one is this Iron Condor. And let's go through the Greeks, just so you can see this visually. So the first Greek we talked about is delta. This pink line is basically what we're looking at. You can see it's delta negative over here, this minus 19. Over here, it's delta positive, but in the middle, it's basically 0, right? If we highlight this calendar option, which is basically a calendar on the exact same underline, same expiration, this delta, same thing. Delta negative here, delta positive here, delta neutral here. These are both the same delta exposure. For theta, we've got a theta positive trade. Remember, Iron Condors profit from the passage of time. This number up here is a positive number. If we highlight the calendar, again, same thing. This pink line, positive number. This is a theta positive trade. The third one, Vega, this is where it's different. So you can see for the Iron Condor, it's a short volatility trade, Vega negative. That pink line down here, you can see minus $25. If volatility declines by 1%, this trade will make $25. Again, all else being held equal. Of course, the Greeks are not an exact science here, but you can see it's actually a Vega negative trade. Well, what happens if we click the calendar? Now you can see it's different. This pink line is above the 0. It's actually a Vega positive trade. This has to do with the structure that we are building here. If you look at what's actually happening with an Iron Condor, the inner strikes are short strikes. They're closer to the money, which means they're going to be, essentially the stronger ones. That's why when the passage of time, if volatility goes down, those ones are going to bleed. A calendar is structured differently, where the short strike is basically the near month, and then the long strike is the far month. But calendars are opened for a debit, meaning you pay the premium to open the trade, and the long strike is a higher price than the short strike. The short expires much sooner, so it's going to be lower premium. And that's why as it's moving around, anything that the market is doing, it's going to affect the higher priced option a little bit more than the lower priced option. So of course, the calendar is going to be less sensitive to that negative Vega of an Iron Condor. Now, I wouldn't say that they are strongly Vega positive, right? Of course, if you wait till expiration, that front month is going to be completely gone, and you're still going to have the back month there. And then the Vega is going to really kick in strongly, because that's going to be a single leg long strike. But having the short open, of course, it moves pretty quickly. It's sensitive to short-term movements. And so it's not hugely Vega positive. But what we can say is that it's definitely more Vega positive than an Iron Condor, which makes it very useful to open during low volatility environments. That's the distinction. Essentially, all of that summarized into we open Iron Condors during mid to high volatility, and we open calendars during lower volatility. Now, little bit of a detour just to let everybody know, I don't run my live streams on, advertising and all that stuff, but there is, for VTS subscribers, a 30 video Iron Condor course that you can go through. It's over 5 hours. You could probably get through it in a weekend pretty easily, maybe a week or two, but there is a full course here. If you want to see some of the individual subjects here, they go on for a while. We talk about the rules of engagement, the trade instructions. There is a spreadsheet so you can track your trades and log. Hopefully everybody gets their first 25 trades in, and then they can start to analyze their past performance, maybe improve a little bit. And then we get into single questions, why do we use wide wings? Why do we use longer dated contracts? This is important. What is high volatility? What is low volatility? I'll get into that in a second. But lots of examples, how to make your large account. If you're trading, $1 million or a couple $1 million, you're probably not going to want to use ETFs at that point. You might want to use the indexes, things like that, how to diversify. But you can notice down here, I start getting into the calendars. This is kind of the important distinction here. One of the rules of engagement that we actually highlight is the fact that, where are you? I know I put it in here somewhere. One of our rules of engagement, there is a full video on this that goes through everyone in detail. I'm just ripping through this as fast as I can. But you can see one of them is iron condors mid to high, calendars for low volatility. And there are slight differences here with the calendar trades, but that is one of the rules of engagement. What I want to just quickly, I said it's not an advertisement, but if you're wondering actually how to get access to this, you're going to go to volatilitytradingstrategies.com. You're going to click the subscribe button and everybody gets a free 2-week trial. Like I said, it's not even going to take you 2 weeks to get through the course. And then from there, you can kind of poke around at all the other courses and the other strategies. Man, maybe you want to stick around, it's entirely up to you, but claim your free 2-week trial at least and check out the Iron Condor course because, this is something that most people obviously would charge a lot of money for. This is just included and it'll get everybody up to speed on everything you need to know about iron condors. Now, what is mid-high volatility and what is low volatility? This is an important distinction. So one of the things I do, and of course there is a lesson in the course talking about this, but one of the things that I do, I have what I call my volatility barometer. This is all my volatility metrics, currently about 13, combined into a single value. So if we go to today's email, this is my email that goes out to subscribers every day. You can see there was a new trade. We're going to take this trade live in a few minutes. And of course, you can take it with us if you want. But this is the volatility barometer value for today. You can see that, 0 to 100. Volatility right now is about 32%. So I would call this sort of in the low range. But that is actually what we're talking about. How do we actually decide? So if you do have access to the volatility barometer, I suggest you use it. This is the best measure of volatility that you will find. There are a couple other ways you can do if you're not a paying subscriber. You don't have to pay me money to benefit from my work. But what we can essentially do is if it's above 33%, just favor iron condors. If it's below, favor calendars. This isn't a game-changing difference. Like I said, iron condors and calendars are quite similar, but it will give you a little bit of an edge. And of course, profitable trading, it never comes in any slam dunk differences. It's always on the margins. It's just making little improvements to your trading along the way. And when you add up 10 small edges, you end up with a highly profitable strategy. So this is one of those edges, understanding when to open calendars and when to open iron condors. So of course, you can do that with the barometer. If you don't have access to it, of course, everybody has access to the VIX index. It's not a very good measure of volatility, to be quite frank here, because remember, the VIX is simply a statistic derived by options activity on the S&P 500. It's something, but it's certainly not a comprehensive measure. And so, but if you do have it and that's all you have, then of course you can just divide the VIX this way as well. And I would just suggest make it super simple. The 30th percentile on VIX values going all the way back to 1986. You notice I included the Black Monday 1987 there. VIX actually went to 150, topped out at 172 intraday that day. So anybody who thinks the VIX stops at 100, remember, it's not an actual practical tradable value. It's a statistical value. And yes, it can go over 100. But anything below 15.19 is the bottom 30th percentile. Anything above 15.19, you'd favor iron condors being mid to high. And the third thing you can do, if you want to use this metric as well, if your trading platform makes it easy to view, you can use what's called the percentile rank. It's typically a 52-week percentile rank, but you can basically, if it's below the 33% IV, calendars. If it's above, iron condors. Now, for Thinkorswim, I can tell you where to get this value. So you just type in any ticker. You can see this is the GLD right there. Just go to the bottom in your Thinkorswim platform, go to today's option statistics, and there it is. So right now, current IV percentile, 18%. Now, I just want to mention really quick, this can be a little bit deceiving because, of course, it's only a 52-week measure. So if, for example, you were in a period with crazy low volatility for a whole year or really high volatility for a whole year, it might actually not represent a number that's accurate long term, right? They might be skewed saying, look, volatility might be actually super low right now, but over the last 5 years, that might not be the case. So just be aware that when you're talking about a 52-week percentile rank, it might not reflect longer term values, but this is fine and you can use it. Again, volatility barometer being the best, but any one of these is also fine. Before we get into the actual trade, I just want to mention the strategy itself, the Iron Condor strategy. We leave space for 3 trades to be taken at the same time, up to 3. You're always better off trading multiple smaller positions with higher trade frequency than you are trading one giant position. Now, the first position will always be equities, right? It will always be something to do with markets. I always trade index options. So basically, here's a list of the top 20 ETFs, the most liquid options. We will always be sticking to the SPY, the Qs, or the IWM. That's when we're trading equities. The second layer, typically speaking, will also be equities. There's a couple of rules within our strategy and within the rules of engagement. You would learn that in the course, that perhaps you can start diversifying away from that, or the second level would be equities. The third level would almost certainly be something else. And the something else, again, we of course need high liquidity. Otherwise, your executions are going to be really poor. There's a lot of, quote unquote, trading services out there that are essentially benefiting from the fact that they're trading smaller stocks and indexes with, low volume. They front run the community. It can really affect things. Entries and exits get all messed up. They're posting performance that looks just staggeringly good, and then you follow their trades and you get nothing even close to what they report. I'm sure people have experiences with that all the time, but the way that you can get away from that is, of course, we only trade the most highly liquid. So there's no front running the SPY. It's just a massive ETF, and all of these are the ones as well. So basically the top 2 go-tos for me personally, I would always default to GLD gold or TLT bonds. Those are sort of what I'm looking first to fill in this level. So let's get into the actual trade. Iron Condors, calendars, very, very similar trades. There's really an execution difference that I have to highlight here. This is why for my email specifically, I told VTS members today, if you do want to skip this trade or wait until you watch the live stream, maybe you can take the trade tomorrow, because there actually is an execution difference here. So I think the best thing that I could do is I could show you what I would do if I opened an Iron Condor, and then I'll just make the small calendar adjustment, because calendars are actually even more capital efficient than Iron Condors. So we can't use the same allocation size. I wish we could. I wish options was as easy as all those trading gurus online say it is. But unfortunately, anytime they're talking about things that are just dirt simple, as I mentioned before, something like covered calls, there's a reason it's dirt simple. And there's a reason that there's a billion free YouTube videos that you can watch in 5 minutes to learn that. It's because there's no edge there. But they'll sell it as if it is. Anyway, that's a side tangent. You get the impression I hate trading gurus. But what I think I should do is go ahead and show you what an Iron Condor would look like on the GLD, and then make the small adjustment. So for Iron Condors, we use a 3% allocation of total net liquidation value of your entire account. This is going to be the proper trading size. The last thing you want to do, like I mentioned here, it is actually a 25% allocation, right? The last thing in the world you want to do is put 25% of your capital into an Iron Condor. That is a massive trade. And sure, slam dunk, high fives all around if you get a winning trade. But if you get a losing trade, or if you string together 2 or 3, which is definitely going to happen, again, ignore what the trading gurus are going to tell you. You will run into periods and market environments that all of your strategies fail, and you're going to get a string of losing trades. When that happens, if you're allocated this big, you're going to run out of capital very, very quickly. So what we do is 15% of the capital is just held in a constant ETF, box, SGov, basically short-term fixed income, just keep up with inflation basically. And then the other 9% is allocated into these 3 trades. We have to do this because, of course, these are allocated correctly to the size of the overall portfolio. So iron condors, and we've got one open right now on the queues, 3% of total net liquidation value. So all you would do, let's just say a $25,000 account. Again, this is your total net liquidation value. So let's say you have $25,000 of total capital to trade the VTS strategies. All you do is take 3% of that. You have $750 for this iron condor. All you do is take $750 and divide by the maximum loss. So the maximum loss of an iron condor is the strike gap, which in this case is $5, $325 to $330, minus the premium of $1.14. So you're talking about $386, right? So you just divide by 386, and in this case, 1.94. This is that tricky little range, 1.94 contracts. With options, you can't trade partials. So I always just say round down and you'd open one contract. Now, just for this, I want to get it slightly closer to the calendar. And let's assume you had more than 25,000. It would be more efficient, but let's just give you two contracts. But that's essentially how we size them. And then we use a 50% stop. So all that is 50% of the premium. This is very easy to calculate, right? 114, 57 cents times 2 is $1. It's $114. So the stop losses for this trade is right there. And let's take it to 114. So the initial stops are here. Now this will change constantly as the market moves around, but those are the initial stops, 50% stops. But calendar options are actually much more efficient. So you can see this one here, it says calendars use 2%. That's the first difference I want to highlight here. So when you open a calendar option, it looks like this, but in this case, that would be an even bigger trade if I used 3%. So I used 2% in this case. So now 25,000 times 0.02, $500, right? The iron condor, we had 750 to use. This one, we only have 500 to use. And you divide that by the maximum loss, which for a debit spread is just the premium that you pay, 175. 2.86, we'll call it. Again, we're talking about close. I am a stickler for the math, and I literally trade to the decimal places. I've said this many times. If I have a trade that is supposed to trade at 32.40 and it's 32.41, well, 32.41 is not 32.40, so I don't take the trade. I am literally that accurate. But some people might look at that and say, I want to get a little bit of extra. So 2.86, it's technically 2. I'll give you 3. Right? So now these trades are sized correctly. This trade is not going to get a $25,000 portfolio into any trouble if you string together 4 or 5 losses. But it can definitely make a big impact if you get 4 or 5 winning trades in a row. That's the point, is that you have to balance that line. Everybody looks at what you'll make if you win. I always look at what I will lose. What could happen? Let's run a Monte Carlo simulation. Let's figure out how I'm never, ever going to cost myself too much money. Then I'll worry about adding profit later on. But I always manage risk first. So this is a correctly sized trade. But the second thing we have to do is we have to adjust the stop losses. So again, a 50% stop would be a little bit much. If I get too many of those in a row, it could be a problem. So we're going to use 25% stop losses instead. Again, calendars are a very efficient trade. So 25% stop loss of $1.73, you just take 25% of that. I'm looking at $129. So the stop losses for this trade, you know what? I'm going to use different ones. And this one's going to be at 129. I don't know. Close enough. And let's double line these for the calendars. And then the high side, let's find 129. And let's double that for calendars. So the stops for the iron condor are the singles, and the calendars are the double. You can see it's kind of the same thing. Right? Width-wise, it's the same. It's just shifted over. The reason it's shifted over is because the volatility exposure is a little bit different. With the iron condor, as this price goes up, the volatility will actually come down, and that's going to skew the trade. Whereas the calendar, it just has a different Vega exposure. But trust me when I say this, and there is actually, I'm sure of it, because this is actually a really visually frustrating thing when people say, well, why is your stop loss so far on the right side and it's so close on the left side? They're actually the same thing. As the market moves around, it is the same thing. So please tell me that I know what I'm talking about. Why do stops look lopsided? Why do they look uneven, right? This whole lesson is going to explain why, even though these look incredibly lopsided, they're actually the same thing. If the market moves down, this double line stop loss is going to move down. If the market moves up, this one's going to move this way. So they're actually going to end up to be the same spot. Neither here nor there. So you can see the adjustment there, 3% and 25% stop losses. Otherwise, these trades are the same. So if you're in the VTS community, that is really all you need to know, is that we're doing these small adjustments. So when I pointed to it in the email, you can see here, allocate 2% of net liquidation value to this trade. This is the one that we opened today. So if you want to see what our portfolio is allocated, of course, the market's doing great. We are short volatility, 2 times long NASDAQ, and S&P 500. It's really the market neutral strategy that we're basically taking trades here, because there's nothing we can do when the market's going to all-time highs. We're not going to be shifting anything over there. So this is the trade. Now, the only thing we have to do is actually take the trade. So, like I said, if you feel like you want to take this trade with me, if you looked at that and you thought, oh, that looks kind of easy, go ahead and take the trade. As I'm going to show you now, I'm going to execute that live. Go ahead and take one contract. So don't calculate all your things, but just take one contract and see how this thing moves around over time. I would suggest that for new people, that's probably what is best. So let's go ahead and take this trade. I'm going to do this reasonably slowly, but as I always want to point out to people, I'm a pretty thorough person. I think if you've watched my live streams and my videos, you understand it. I'm pretty detail oriented here. I like to be thorough, and it does give the illusion sometimes that this is more difficult than it actually is. But trust me, once you do some of these, it's going to be so fast. If I wanted to do this, not like it's a show-off competition, but I could execute this in less than a minute. It's really, really easy. So don't be intimidated by all the Greeks that I went over and the stop losses and all that stuff. This stuff, trust me, after 2 or 3 trades, you'll be a whiz at this as well. It's really not that complicated. And given that in the VTS community, our official performance that I post on the website is always coming based off a $25,000 allocated portfolio of live trading within this TOS account, right? This is just a public TOS account. This isn't my trading account, but this is live trading, but it's just kind of something that I can show my account values. You will actually see the account numbers in a second here. I don't want to be on a live stream trying to be careful what I click on and, oh, don't show this and don't show that. So I just funded this account with some money. And so we can do this, but I'm only using 25,000 of this always. And all of our performance is live fill prices. So what we do, $25,000 portfolio, but let's see how to open a calendar. I'm sure your platform, whatever you use, is going to be quite similar, but you just go to the trade tab. I'm going to find the strikes that I'm using. So if you follow the emails, it's basically pretty simple. You're going to sell the 15th of August and you're going to buy the 19th of September, 308 puts. Now, again, it's going to build it for me. This is not overly difficult, but I'm going to basically, first of all, find that 15th of August, because this is going to be the short month. And I'm going to find that 308, and I'm just going to buy a calendar. And when I click this, it's going to know what I mean by a calendar, right? But obviously, if you're using a different software, you're going to want to check these. So just make sure that the one that says a minus is the August and the one that says a plus is a September. Again, it's going to know how to build it for you. And once you do a couple of these, you're just going to go through this in 1 minute. But I'm going to go super slow. Then make sure, of course, you're using the 308. Then we have to do the allocation sizing. So I've got $500 to spend. And right now, it does look like the premium is about $1.75. So if I take my 500 divided by 175, the reason it's not 1.75, by the way, is because one option contract is equal to 100 shares of the underlying. So you just times it by 100. Eventually, you'll do this all in your head. It's really a breeze. But again, 2.86. This is going to be a problem. And this is the live trade, remember. So in this case, I am going to be a stickler and I am going to do 2 contracts. So what I would do is I would go 2 contracts, and now we do something called the 30-second rule. This applies to all option trading, not just calendars and iron condors. The 30-second rule, I believe, has a separate video somewhere here. Trade execution and the 30-second rule, lesson 9. See, there's a video for everything. I think I did a pretty decent job of that course where every general question that you're going to have has its own dedicated video in there. But the 30-second rule is essentially just how you get good fill prices. You don't have to sit in front of your computer all day long. These are computers. They kind of match up prices pretty well and pretty fast. It happens like lightning. But you also don't want to always just pay, you can see down here the mid and the natural. If I went $1.85, I might not get the best fill price, right? So 175 appears to be what the mid is, but there's nothing wrong with trying to get a little bit better, right? You don't have to nickel and dime everything. Just get your trades done and move on to the next trade. But nothing wrong with trying for a little bit better. So the 30-second rule, I'm going to input a price slightly better than I'm expecting to get, and I'm going to wait 30 seconds. So $1.75 for a debit spread, it's actually beneficial if I pay less as a debit spread. If you're selling something, you want to sell it for more. If you're buying something, you want to buy it for cheaper. So I don't want to pay $1.75. I might want to pay $1.74. Let's go ahead and see. And like I said, somewhere on here, there's my account number. I don't care, whatever. Let's see. So it's saying the mark is $1.75. And right now I'm trying to get $1.74. So I would just wait 30 seconds, maybe 20 seconds. Like I said, these are computers. They're really, really fast. It's a live stream, so I'm just going to go ahead. All you have to do is just change the order and just click it up one, right? Let's see if I get this one. 175, and I did. Just don't go in there with the natural, if you're buying something, don't go just on the bid or the ask. But like I said, every single thing we trade within the VTS community is highly liquid, always highly liquid ETFs and options. We don't do any low liquidity things. It's a problem. So that's it. The trade is done. I believe I already executed one before, and I believe it was even the same price. So let's clear all these out and let's look at this trade. So this is the calendar that I just opened. Remember, it is quite an efficient trade. So I didn't allocate very much capital. But again, what we're trying to do, so you can see the break-evens were roughly 298 and they were 322. So if we were to look at this trade now, this one, nope, let's remove that. 298 to 322. It's about, actually the low break even, practically speaking, would be about 290, and it wouldn't go up to 322. It'd probably drop down to about 318, something like that, 319. We'll just call it 319. It's actually something like this. This is what the trade looks like. And you can see the goal, GLD gold, hopefully in 20 days or so, it is somewhere within this range. Because we use the stop loss and the stop gain, this trade is never going to make it the full expiration. You can see there's 45 days to expiration. This trade is not going to be open longer than 15 or 20 days, maybe 25 or something like that. But it's going to hit either the stop loss, it's going to hit either one of these points, maybe gold makes a big move and we lose in this trade, or again, we just capture that slow ticking up theta. This pink line day after day will just get a little bit higher, a little bit higher. And when it reaches a sufficient price, we're going to take our 25% stop gain. Of course, I will send that out in the daily email, so you don't even have to take care of that. That's kind of the point of me being here, is that I'm going to be entering and exiting the trades and telling you how to do all this. And anytime it's kind of, an option trade, you can see I show the trade, the option sizing, how to calculate this. Again, you could, after 2 or 3 trades, you'll do this in your head basically, but people are intimidated, so I go over it. Basically, a pretty simple trade. There's really only 2 differences between calendars and iron condors. The first one is that the iron condor is vega negative, short volatility, and calendars are, at the very least, you could say vega neutral. But the way that we trade them, closing them out really quickly, like 25% stop loss, stop gain, they actually behave as a little bit vega positive, which is good. It it adds diversification to the portfolio. And the second major difference is that calendars are actually more efficient than iron condors, just capital wise. So we have to make those two small adjustments. You have to basically go down to 2% allocation from 3, and you have to use 25% stops instead of 50% stops. Easy stuff.